Good morning and good afternoon, everyone. So, in aviation, every great flight starts a long way before takeoff with the right financing. This is why we'll be having on board of today's webinar four speakers bringing their respective perspective to cover not only the airline industry, but also their broader ecosystem. My name is Valentin Mory. Uh, I'm um, uh, I'm in charge of the transportation and mobility topics here at Natixis CIB Research, and it's a pleasure to moderate this talk today on the airline industry. So, joining me today, we'll have Joel Hancock, our oil and gas specialist here at the research team of Natixis CIB, Charles Zhou, head of aviation finance for the APAC region, Alain Rousseau, head of aviation finance for the EMEA region, and last but not least, Jean Chedeville, Natixis global head of aviation finance. So this webinar follows the publication of this eponym report that has been published a few weeks ago. So don't hesitate to reach out after the webinar if you are seeking for a copy of it. Lastly, please keep in mind that we'll have a quick Q&A session at the end of the webinar. So feel free to drop your questions in the sidebar during the presentation, and we'll try to answer as much as possible at the end. Without further ado, let's start with today's menu. So starting with a 360 view of the airline industry and its drivers, with this question, is sky the limit? Secondly, we'll move to the aircraft production, its recovery trend, and also discuss the topics of MRO, maintenance, repair, and overhaul. And we'll then move to more European-related topics with the improving credit strength of European airlines, and also the key questions there in Europe: consolidation versus integration. We'll then move to the conclusion and the Q&A session at the end, as I mentioned. So let's start with the 360 view, and with this basically the airline industry is now back on track and is poised for a 3 to 4% compound annual growth rate for the next decade after, let's say, tough times post-COVID, and is now expected to outpace the GDP in most of the regions, with obviously different drivers and some now we are now seeing some regions that are now driving more the growth. We'll come back to this later, and some that are more stabilizing, like in Western Europe, as you can see on the screen, and in North America. This is positive for the airline industry, despite a lot of geopolitical pressure that are currently up and running. Here, a first focus on the US, as the tariffs narrative has taken a lot of times to our macroeconomic research here. With these two, with basically a view that so far the tariff have not impacted that much the airline business or the local airlines business. You have on the left-hand side of the slide the adjustments for the expectations on profitability of the big 4 airlines in the US. And so far, for the most recent publication of their results, they have mostly positively surprised investors, and mainly because people are still traveling, and they are also still traveling with premium options. We'll come back to this later, but here on the right-hand side of the slide, we can see that there's at least a small weakness that we can see on the green curve, which represents the non-US citizens traveling to or from the US. This is the only part of the market that has started to see some decline at the very end of summer, while the purple curve representing US citizen departures to international regions is still doing quite well after having recovered from the post-COVID. Now moving to the geopolitical pressures that are up and running between the European region and the Asian region, i.e. the wars in both Ukraine and the Middle East. Actually, they have not that much neither impacted the traffic flows. As you can see on the left-hand side of the slide, the post-COVID has seen a very quick rebound between Europe and Middle East in terms of traffic flows. And keep in mind that these traffic flows also then lead to traffic flows between the Middle East and Asia Pacific, with the hub strategy of the Middle East-based airports. In Asia, the trend has been the rebound has taken a bit more time to recover from the COVID impact, mainly related to the slower opening of the market and the longer lockdowns in the country. Just sharing with you a few figures. China seems to be leading the charge with 1/3 of the traffic between the two regions. And also a quick comment on cargo, which is accounting for about 16% of the total flows between the two regions. Cargo has seen a strong post-COVID recovery. Let's say that the cargo flows have been beating new records since 2020 already, and they have seen a quick dip in 2022 with the war in Ukraine, but this has recovered quite rapidly. On Asia Pacific, here to walk us through the growth trend in Asia is Charles Zhou, as mentioned at the beginning, head of aviation finance for Asia Pacific at Natixis. So Charles, with the post-COVID recovery behind us, has APAC reclaimed its position as the primary growth driver in the airline industry? And is this growth uniform across the region?
Thank you, Valentin. I think the short answer is yes. The APAC market has already been in the level or above the pre-COVID level. As you mentioned early on, China is probably the last country who opened it up after COVID. By end of 2024, the traffic number of China was already 10% higher than the 2019 level, which is before COVID. The other countries who opened up earlier, they already reach out to the pre-COVID level. To answer your second question, that whether that's uniform across countries and regions within APAC, the answer is no, because different countries have different economic growth, have different people composition and economic growth. So it's slightly different, but overall Asia Pacific, with the strongest potential growth in the GDPs and the traffic flows, have already leading the way, particularly for China and India as two of the major countries who have the highest GDP growth rate and also the fast growing middle class. So we have seen a big potential in terms of the air traffic, and also according to Airbus and Boeing, there will be a lot of aircraft to be delivered into this region. Boeing's latest current market outlook 2025 forecast that the aircraft delivered into this region will be doubled in the next 20 years. Back to you. Thank you.
Thank you very much, Charles, for your insight. So, as we have seen, geopolitical pressure does not seem to be enough to impact the rebound and the good trend in the aviation industry, mainly with this other topic and these two topics that are key to support, and as said, fuel and forex are definitely the name of the game currently for airlines. Foreign exchange, because with a weak euro dollar, basically this is a strong positive, mostly because also oil and a lot of costs are denominated in USD, while the revenues for the airlines, except the ones in the US, are mainly denominated in other currencies than the USD. So you can see here the latest forecast for by the macroeconomic research at Natixis that is seeing basically a quite stable trend to where we are currently in terms of Euro USD exchange. Now moving to oil, which is used to account for 20 to 30% of the cost base of an airline. The trend has been downward oriented in the last years. So this has been a strong positive, and this is, in our view, the main shield to a turnaround in or downward trending cycle in the airline industry. But here to walk us through the oil trend topic is Zhou Hancock, Natixis CIB research specialist for oil and gas. So Zhou, can you share with us some of your insights on the oil market, and maybe dive into the perspective in the coming months?
Yes, of course. Thank you very much, Valentin. So what I would say is that we've had a relatively high volatility year when it comes to news flow for the oil market, but prices have actually been relatively low volatility, trading in a $60 to $70 per barrel range for Brent. And where do we see the market for the coming months and into 2026 and 2027? Well, broadly, we do expect Brent to remain at relatively low levels and step even lower in the first half of 2026, an average of around $62 per barrel Brent for the average of the year. 2027, somewhat of a recovery, but still only around $65 per barrel. So what's driving this forecast? Well, it's broadly fundamentals. We've had a very strong year when it comes to supply growth in 2025. So non-OPEC growth from your typical suspects, US tight oil, with the sector up around 0.2 million barrels per day. Very strong growth from conventional producers, Brazil around 0.2, 0.3, Guyana adding similar volumes. So that's around 1.1 million barrels per day. OPEC have also begun to unwind production cuts. So around about 2 million barrels per day higher, that group's production currently to at the start of the year, with Saudi's market management strategy potentially shifting more towards volume rather than value. Now, obviously, that supply growth has to be balanced against demand. Liberation Day was feared to be a major pull on growth, given the fact that the oil prices and oil demand are very kind of levered to global trade. The worst case scenarios didn't materialize, but we're still looking at something like 0.8 million barrels per day. So for 25, similar numbers for 26 as well. In the context of that supply growth, which we expect to continue in 2026, particularly on the non-OPEC side, ultimately, that's not really enough to offset that growth. And so we're expecting to see very strong inventory builds, particularly this quarter and next quarter. And for us to balance this market, we are going to need to see supply rationalization, given the fact that demand has been not particularly weak, but not amazing either, especially in the context of that strong supply growth. So that supply rationalization, it's going to come in the form of short cycle production slowing, that growth slowing, even turning negative. So that's US tight oil, shale oil. We're also going to have to see OPEC stepping in to cut production again. We expect an OPEC cut in Q1 driven by the low prices we expect in that quarter. We also expect to see US production declining next year at our current WTI forecast around about 0.2 million barrels per day year on year. So in our view, this can rebalance the market over the second half of 2025 and into the second half of 26, and into 2027. The risk to our oil price forecast, I would say, is more to the downside, given the fact that OPEC might not step into the market with a cut. In that case, we would need to see stronger declines from the non-OPEC side. So that would imply US shale oil having to decline more than 0.2 million barrels per day to balance the market, and Brent likely around $5 lower. We also talk quite a lot about a potential Russia peace deal, or Russia-Ukraine peace deal. Here, we don't think it would be too relevant to the oil market, given the fact that Russian material has broadly been kind of kept on the market since 2022. However, we do think from a sentiment perspective, this could also bring prices slightly lower than our current base case forecast. I'll talk briefly as well about jet cracks, if we could move on to the next slide, because here we have seen significant upside in recent months. This is mainly due to the risk surrounding Russian barrels, Russian material. We've had Ukrainian drone strikes on Russian refineries. We have had major exporters of Russian diesel placed under US sanction. And the latest risk surrounds the third-party refinery ban that was put in place as part of the EU's 19th sanctions package, effectively Indian, Turkish refiners running Russian crude will be unable to export products to the European Union. Going forwards, what we would say as well is that those Russian supply risks have occurred whilst the market has been incredibly long from a speculative standpoint. So hedge funds have piled into the trade based on the risk of some of that supply loss, but also seasonally when refineries have been in maintenance, so supply generally has been lower. we do expect to see diesel supply increasing into December and the rest of the winter, so into Q1 26. And at the moment, the Russian supply losses are relatively theoretical. So effectively, Russia has been able to maintain exports despite some refinery outages. Effectively, other refineries have been increasing their utilization within Russia. And we don't think the European Commission is actually going to enforce these sanctions to, the harshest interpretation of the rules, effectively. So we do think that Russian materials stay on the market. We do think that effectively the supply increase that we'll see in the next quarter will also loosen that market as well. Given the fact that cracks have been pulled higher by speculative players, we do think the unwind of some of these positions as the supply side improves will push cracks lower. So for the second half of 2026, we'd expect jet cracks to be something in the region of around $20 per barrel rather than the extreme levels that we've seen over the past month or so. And I will leave it there and pass back to Valentin.
Thank you so much, Joel, for these insights. Apparently nothing too worrying on the oil front so far. And I take out one of your quotes. Risk on our forecasts are more to the downside, if I get it right. So maybe another way to track whether or not the end of 2025 and early 2026 could show some weakness in the airline industry or in the passenger flows is looking at what has been the cherry on the cake for the past 12 months, at least, the shifting consumer trends, which is something that has emerged after the COVID pandemic. This famous travel revenge that has pushed a lot of people to travel, but also to travel at a premium. This is, as you can see on the right-hand side of the slide, the premium word has been mentioned, increasingly mentioned in the conference calls for results for the main European and US-based airlines, showing how positive it was. And also considering that these premium options are contributing to make the outperformance in terms of profitability for these companies. And basically, the first negative trends or the first worries have came out of the Q3 results season. Especially in Europe, with several companies showing still some decent premium volumes, but maybe hints of weaknesses in the economy class. This has been rapidly related to the now famous K-shaped recovery, whereby the lowest income households are now decreasing their consumption, while higher income households are still consuming at a fast pace. So far, this has been only seen over a quarter, but this is something we are looking at more intensively we'll be looking at into the next quarters to see whether or not this is the door for the market a cycle downturn or not for the airline industry, or whether there still is a few quarters to come to help rebuild their balance sheets before preparing for the next downward trending cycle. This marks the end of this 360 review of the airline industry. This was the biggest part, obviously, of this webinar. Now we're switching to the assets part and the aircraft production that has been impacted a lot since the post-COVID, since the COVID pandemic, and which is still impacted. But we are seeing here some hints of recovery with quite positive comments from Airbus and Boeing and also engine manufacturers in terms of output for their respective products. Here you have kind of a mapping of the commercial aircraft value chain with three main actors: the OEM part with the airframers and all their suppliers, the maintenance part, which is taking some importance, and we'll come back to this later, and let's say the users of these aircrafts, commercial airlines, the cargo, and do not forget the lessors that are now accounting or at least holding about 50% of the airline fleet nowadays. Here to walk us through the aviation industry from an asset financing perspective is Alain Rousseau, Natixis head of aviation finance for the EMEA region. So Alain, as you closely follow the asset values, can you explain the link between aircraft values and the high volatility that we've just talked about in the environment of airlines, whereby airlines are operating in?
Hi, Valentin, thank you. Yes, indeed. So as most people know, people tend to be very emotional when it comes to aviation. Some people love it, some people are afraid of flying, some people are against it for environmental reasons. And on the investment side, there is also an emotional behavior when it comes to aviation from investors. And for good reasons, because as you mentioned, airlines have some volatility in their performance. This has been improving over time. Airlines are now better managed than they used to be. Some airlines have been constantly performing and profitable, but obviously we all know that their bottom line can be quickly impacted by cycles, by demand, by geopolitical environment, or fuel prices. Now, very interestingly, when it comes to the value of aircraft, the value of the asset, and I'm going to focus on commercial jets, so the larger aircraft. Unlike the airline performance, there is a lot of predictability and a very little volatility on the aircraft value. And this is because, first of all, we have a sort of duopolistic market with only two big manufacturers, being Boeing and Airbus, obviously. And they have only a few products to offer to the market, a few aircraft type on each side, and very standard product. So whether you're flying an A320 in North America or in France or in China, you're basically going to fly in more or less the same aircraft. So it's a very global and standard product, and very easy, obviously, to move from one region to another. So it's a very harmonized market with very little product. On top of that, the capacity, the seat capacity globally is growing steadily for different reasons. First one being that obviously there is a stock of aircraft that is available and those assets have a long life. Second point is because aircraft manufacturers are not producing aircraft on a volatile basis. They have a production line and they are constantly pouring new assets, but deliveries of new assets is gradual. It goes through the years and it's planned over the next 5 to 6 years. Obviously, the airport capacity is also growing steadily. So there are a number of infrastructure that allows the growth of seats to increase. And the demand generally also follows the GDP growth, so the global GDP growth, meaning that even if there are some shorter cycle on the airline profitability and on aviation, there is again long-term and structural demand for seats capacity. And the last point that supports the asset value is inflation. Inflation is actually playing in favor of pushing the values of those assets, even if they are depreciating assets, but inflation plays as a positive impact on its value. So all in all, that means that all the names you see on this slide, being the manufacturer, the OEMs, the MROs, the supplier, and so on, there is a lot of value that is created in the aviation industry. And from an investor standpoint, you can almost look at investing in the asset, in the aircraft, as a sort of fixed income investment, because again, you have a lot of predictability into the future value of those assets. You can lease those assets, very similar to a building, and have some rental. So unlike investing in airlines that are operating the asset, investing in the aircraft is a very predictable business. And last point is that to illustrate that the bank has a very low cost of risk on its aircraft financing portfolio, which is one of the lowest cost of risk of the financing business line of the bank, and it's actually a single-digit cost of risk. So, which again shows the predictability of values. Thank you, Valentin.
Thank you, Alain, for these insights. So, as you rightly mentioned, a high volatility on the airline industry and extremely low volatility on the asset financing part. Take out one of your quotes that aircraft investment is closer to fixed income investing than something more close to equity investing. Now moving to the fleet, to analyzing a bit the fleet we have currently running and the expected deliveries to illustrate what Alain just mentioned. So the COVID pandemic and the year following it have led the fleet, the average age of the global fleet, to increase. To explode by now this is reaching exceeding 14 years now, because both Airbus and Boeing were unable to produce at the large capacity in the 5 years post-COVID. We are still, and you can see it on the graph on the right-hand side of the slide, both Airbus and Boeing had yet to get back to their yearly production level that they've reached in 2019. So this explains also the missing aircraft that are in the skies. This has been partly compensated by postponing the retiring of older aircrafts. We're talking about aircrafts aged about more than 25 years now. and this will take a lot of time to improve. The latest forecast by IATA are talking about come back in about 10 years to both compensate for the missed production and also fuel the growth, because there is also growth out of that. So here we see two catalysts for the rebound, and two things to follow closely to monitor whether we are in an improving trend or not. Engines, as mentioned, and also the recovery of Boeing, which has also some idiosyncratic issues to deal with. So all this has created and fueled a new super cycle, let's call it like this, in the MRO sector, namely the maintenance, repair, and overhaul sector, which is an even less known part of the production of aircraft. But just to share with you a figure, the MRO market is worth more than $100 billion, which is about the size of the market of the production of aircrafts. So this is a large market which is supplying, which is also helping these aircraft and these assets to live, as I was mentioning, more than 20 years, sometimes 30 years as well, by being maintained. The key part in the MRO market is once again the engine, which is the key part, the key component for the aircraft, and you have also a split in terms of operators in the MRO market. Some airlines have divisions doing the MRO things here, and the number one being Lufthansa Technik, which is the largest one, and the others and the more significant one are also the manufacturers of engines, also related to the size of the engines. Coming back quickly to you, Alain. So with the spare parts being that key for the industry, are there similar financing mechanisms specifically designed for the parts financing?
So unfortunately, at this stage, financing or investing in spare parts is not exactly the same as aircraft. The reason being that when you are financing an aircraft, it is very easy to identify and to track. You can actually track it in real time and know exactly where your asset is. It is also a valuable asset, so it makes it easy to make a large investment or large financing into a single asset. Same goes for engines. They are easy to identify, they are easy to track, not in real time, but also easy. But when it comes to smaller parts, landing gears, spare parts, it is much more difficult to track down. It is possible, but it requires specialists to do so. What we, however, anticipate is that this may improve in future and will be optimized probably thanks to blockchain or AI, and will probably be able to track those components in a more efficient manner going forward, which will probably help to fuel and finance this segment of the industry.
Thank you, Alain. So this concludes this part on the production of aircraft and their parts. So the key parts to remind here being the fact that there are production constraints that are also touching MROs, because MROs are using the same parts as that can go to OEMs as well. So we're talking about the super cycle of MRO, which is a bit dragged down by the availability of parts, the prices of components, and the third part is also the availability of staff, which is a key drag for the industry. Now moving to our third part on the European airline industry, and quickly on the improving credit strengths of the industry. Here, an example of the 10-year rating trend of Air France, KLM, IAG, and Lufthansa, with huge downgrades during the COVID pandemic, strong rebound since 2022-2023. This has been triggered also by a strong deleveraging trend, pushed by, as mentioned, very strong operating performance. Though one thing which is interesting to note here is that this deleveraging has been slowed down by record investments. So CapEx, the CapEx envelope has been and is still going to remain very high, mostly to drive the fleet renewal. We've talked about aging fleets. Plus, there's the fact that the new families of aircraft that are being delivered currently, that are set to run with 30% less of fuel. So this is a balance to have between investing in the new aircraft to hope for 30% decrease in the oil bill. And managing the balance sheet on the other side. Hence the importance of tracking whether the cycle turnaround is nearby, or if there is still a few quarters for the main leverage airlines to deleverage on the back of strong operating performance, because the CapEx part is much less a moving part. Coming back again to you, Alain, quickly on this, can you give us some insights on how this deleveraging trend commercially translates for you and your activity in the asset financing?
Yeah, thank you, Valentin. So indeed, I think we look backwards to understand what happened. During COVID, airlines were grounded, and they had to work a lot on liquidity. So liquidity was the key for survival for all airlines, and they had to build a buffer of liquidity and to obviously increase a lot their leverage. Meaning that when operation restarted and corrected, one of the key focus of the airline was to reduce that leverage, which was higher than historical trends. They have been able to do that heavily and to drastically reduce their leverage in 2023 and 2024 for two reasons. First of all, these were record years for airlines in terms of profit and in terms of cash flow. I would say that there was probably less intense competition between the airlines. Probably they were all on a break of competition, and there was also a rebound of traffic, and people were prepared to pay a higher price for their aircraft ticket to fly again. The second reason why they were able to reduce their leverage was that a number of aircraft deliveries have been postponed. They sometimes on purpose. It was the order book was restructured between the manufacturer and the airline, and sometimes it was just a fact of life because the OEMs were not able to deliver as planned initially. So there are delays on the supply chain. So airlines have not rushed into putting back some aircraft on their balance sheet, but now this is over, and airlines are, I would say, in a more challenging environment in the sense that they do need to take aircraft deliveries now, so they do need more capacity to answer demand. They do need to take more capacity to answer competition, and on top of that, competition is increasing again. So airlines are still making strong performances and good years, but 2025 has been probably a bit less beneficial for airline than 2024 and 2023. So overall, there is a deleverage trend, but which is sort of fighting against the need for capex, the need for investment as well, and we'll talk about the consolidation trend later. But overall, I would say that the financial conditions of the airline and their rating has improved a lot generally. There are always a couple of exceptions, but that means that airlines also now have a stronger bargaining power when it comes to dictate terms to their suppliers and financiers.
Thank you, Alain. Increasing or improving part of the deleveraging, increasing competition again. That leads us to our final part on the European market. And we're talking about the consolidation now that the balance sheet have been improved. Consolidation versus operational integration. I will show you this graph rapidly to highlight these three markets: Europe, the US, and Asia, with the number of seat capacity offered by the top 10 airlines for each region. With that, you clearly see that the US is the most consolidated market. This market has its specificities. Now in Europe, and I will ask also the question for Asia. So Alain first and Charles then. Where is the European market trending? Are we expecting consolidation or rather something about integration? And later, Charles, you can take the mic as well to share with us your insights on the Asian markets.
Thanks, Valentin. So the first thing to understand when comparing Europe with US is that we are looking at a much more fragmented market in Europe with much more countries. The US market obviously has almost a single market, maybe two if we include Canada. But in Europe, you have a multitude of countries, and each country has its own flagship carrier or domestic airlines. So that means that on this graph, if we look at the top 10 European airlines in terms of seat, they are smaller than the US. But if we were looking at the entire European market in terms of seat capacity and demand, Europe would be bigger than the US market. But again, it's a more fragmented market, and it's difficult for airlines to be across different countries. For historical reasons, there is some protectionism from the countries. Sometimes it's legally not possible for an airline to acquire a majority stake in another airline in a country. So as a result, what we see in Europe is, rather than seeing a pure consolidation where we would have, for instance, a single huge airline that would be across, I don't know, France, Germany, Spain, we see groups of airlines like IAG or Air France-KLM joining force together, having some shared participation or some minority stake, and trying to integrate operations. So rather than having a pure financial consolidations of operations, we see of the business, we see rather some consolidation on the financing side, but most importantly, some operational integration. I think a very good example is the Air France-KLM case. They recently acquired a stake in SAS, and they may go majority on that one. They may be able to do it, but most importantly for them, what they want to do is to drag the capacity and the traffic towards the Paris and the Amsterdam hubs. And again, also Air France-KLM are two separate airlines, but their networks are much intricated. And lastly, now on the European market, we know that the Portuguese flag carrier TAP is on the block. So the Portuguese government is looking at divestment, minority divestment from the airline up to 45%. And the obvious candidates are the three big airline groups in Europe, being IAG, Air France-KLM, and Lufthansa, and they will fight fiercely for these assets, not to become a majority lender on that airline, but to be able to integrate the networks and the operation of the TAP airline into their own networks. So this is where really we see a lot of synergies happening. Thank you.
Yeah, maybe I comment a little bit on APAC market. Aviation industry has been treated by every government as strategically important for the country. Therefore, as Alain mentioned earlier on, each country will have a different level of protection of the industry. You see national carrier from each country, and also in the same country, the other big market would be the low-cost carrier, which is normally dominated by the local players who have a very good understanding of the local market. Therefore, it's relatively difficult to see a merger and acquisition or consolidation across countries. It's similar to Europe. In Asia, you have a number of countries. Each country, each government wants to maintain their independencies on their operation of the aviation industry. So in the last number of downturns of the market, there are a number of consolidation happened, but the majority happened within one country. So during the COVID, we see not much in APAC, maybe only just two. One is in Korea, which is still ongoing, the merge between the two large airlines, Asiana and Korean Air. So now the consolidation is almost done. They just wait for the final consolidation from the operational perspective. The other example is India. So we have witnessed the combining between Vistara and Air India. So that's the only case in Asia. As you can see, that is mainly within countries. Across countries, it will be very difficult. That's my 2 cents for APAC. Thank you.
Thank you very much, Alain. Thank you very much, Charles. I had a very last slide, but Alain covered it really well on the ongoing consolidation. So what we are looking at, and stay tuned for TAP Air Portugal with the privatization, which is into the process, and we should have some more news in the first half of 2026, while we have recently seen Turkish Airlines entering the capital of Air Europa, and which is now sitting next to IAG to co-lead and solidify the company. We are now coming to an end. Just before we do a quick conclusion, Just as a reminder, you can drop your questions for the upcoming Q&A. I think we'll have a few minutes to cover some questions. So drop them in the comment section, and we'll read them out afterwards. So for the conclusion, here to walk us through the conclusion of this webinar is Jean Chedeville, Natixis Global Head of Aviation Finance. So Jean, can you wrap all this up, adding obviously your business view into the speech?
Yes, Valentin, happy to do so. And a lot has been said today on the status of the industry and its ecosystem. And we've talked about the airline industry. Obviously, demand for travel is still very strong, mostly fueled by premium demand. Cargo business is also really good when we see the latest numbers. So overall, airlines profitability has been picking up very well since COVID. We see the cash position of these airlines being at a very healthy level, quite unusual actually for airlines on these post metrics. And that's not always even in our industry, which is quite cyclical. This time, what we realize it's quite homogeneous. Meaning, if you look at the split by region, we see Asian airlines, mostly flag carriers, who took a little bit more time than others to recover from COVID, are now ending their restructuring plans and getting into growth phase again. We're seeing, so that's for the flag carriers. The LCC, though, in Asia is still a point of concern. And I would say this is a common theme in the US as well, in North America, where 95% of the market is covered by the major airlines, and the LCCs are struggling to grab market shares. Just to add a bit of perspective on the very positive notes, if we look at Western Europe, we just talked about potential consolidation. I mean, there you have three major groups of airlines and very robust low cost as well. So, and the two are living together in, I wouldn't say in harmony, but in fierce competition, but each of them driving good positive economics. So on the airline side, really positive. Obviously, airlines are used to navigate difficult environments, uncertain environments. They are used to hedge their risk, it being internal or being on the outside, FX, interest rates, oil prices. I think today those risks are not the main concern. The main concern is really the uncertainty on the geopolitical scene. And so we are seeing strategies being derailed, postponed, or sometimes accelerated because of that environment, uncertain environment. We spoke also today about the asset value, and that's a component that is bringing much more visibility to everyone in the ecosystem because that's stable. That's stable, aircraft are flying longer, the average fleet is getting older, but there is still a lot of demand. And obviously the OEM are super happy because today they have an order book for 10 years. I don't know many industry players who can say that they have revenue committed for the next 10 years. So looking at the assets, this obviously will drill down to the rest of the ecosystem, the supply chain and the MRO, which today on the MRO side, maintenance side of things especially, will be more busy because aircraft are flying longer, and so they need to go into maintenance shops more often. And then the global fleet is expected to double in the next 20 years as well. So that's significant. So there is a mix of refleeting and a mix of growth that should drive more revenues to the broader ecosystem of aviation. Those two positive trends on the credit side and on the asset value side, and I'll finish with that, is leading to a lot of liquidity into the space. We saw little liquidity post-COVID because of the environment, obviously, and the restructuring plan that were going on. In today's market, we see a lot of liquidity. You see it from banks, more regional banks, more local banks coming into the space. You also see it from the bond investors. The bond investors are coming back to, and we see that the spreads on many issuers in the space are now getting very, very tight, historically tight, actually, which is very interesting. And the last piece of the liquidity will be the equity components. And here as well, we see across the value chain And we expect more consolidation to happen thanks to that, because more liquidity is there, driving for growth. So I'll stop on this. I think we've covered a lot that was very interesting. Happy to move into the Q&A, Valentin.
Thank you very much, Alain, for this deep dive into the financing and this conclusion on the increasing availability of liquidity in the space. I think we can now move to the question and answer session. So as mentioned, do not hesitate to send your question. We might have few minutes to discuss it. Let's see if we have a question already in the chat. Sorry for that. Okay, I can see a question here. So which is, in the recent years, many airlines had to negotiate collective agreement, leading to increased staff costs, which are now representing more than 30% of revenues. How do you see the long-term impact of this trend? Obviously, this is an extremely right question. We talked about the oil trend because this is something that moves quite fast. But the other key part of the cost base of an airline is obviously its staff costs. So obviously this is a drag, and this is also why there is a clear emphasis on trying to track whether the demand is still strong in the operating side, because on the cost side there is still this threat of the staff cost pending, and this is something that is hard for airlines to move on. Basically, to make a long story short, this is the kind of the less moving part of their cost base, and we are seeing this with a lot of airlines that are struggling to make restructurations also on this part of the business. So I think this answers the question. I'm afraid we won't have that much time for more questions as we are running out of time. But do not hesitate to reach out directly. You have obviously the email available. One thing to mention to finish, and this is an ad for the next event by the Natixis CIB research, which is the Outlook 2026 for the whole research that will be held next Tuesday. We'll be having 3 sessions, 2 in English, available for the APAC region and for the North American region, the American region, sorry, and 1 in French in the morning. Thank you very much for attending this webinar. We hope you had the opportunity to extract as much information as possible, regardless of your knowledge of the sector, and we hope as well that this webinar will be the first of a longer series. Thank you very much and have a good day. Bye-bye.